One US dollar can be exchanged for less than €1, but that same dollar can also be exchanged for tens of thousands of units of another currency. How is that possible? If it's still the same dollar, why does its value seem so different depending on where you are? The answer has very little to do with the number printed on a banknote. A currency's value is shaped by inflation, interest rates, international trade, political stability, and investor confidence. Every second, banks, businesses, governments, and investors exchange currencies around the world, causing exchange rates to constantly change. But it wasn't always this way. For much of modern history, many currencies were tied to gold through a system known as the gold standard. Under this system, governments couldn't simply print unlimited amounts of money because every unit of currency had to be backed by a certain amount of gold. This helped keep exchange rates relatively stable and limited how much money governments could create. However, as economies expanded and global trade grew, maintaining the gold standard became increasingly difficult, especially during wars and financial crises. In the early 1970s, that system finally came to an end. If you'd like to learn why, we explain the full story in our documentary about the Nixon shock. Since then, most countries have used what is known as fiat money. Unlike gold-backed money, fiat currency isn't backed by a physical asset like gold or silver. Its value exists because governments recognize it as legal tender and people continue to trust and use it every day. That also means its value can rise or fall depending on how much people want to hold and use that currency. So if modern money is no longer backed by gold, what actually determines the value of one currency compared to another? Let's find out. If inflation can weaken a currency, interest rates can often help strengthen it. An interest rate is simply the cost of borrowing money. For example, if you borrow $1,000 at a 10% interest rate, you'll have to repay the original $1,000 plus an extra $100 in interest. In most countries, interest rates are set by the central bank. In the United States, that's the Federal Reserve. But what does this have to do with exchange rates? The answer is investment. When a country offers higher interest rates, it often becomes more attractive to investors because they can earn better returns on their money. For example, investors may choose to buy government bonds. A government bond is simply a loan to the government. In return, the government promises to pay interest and return the original amount after a set period of time. To invest, foreign investors first need to buy that country's currency. As more investors exchange their money, demand for that currency increases, which can push its value higher. The opposite is also true. When interest rates fall, investments often become less attractive. Some investors move their money to countries offering higher returns, reducing demand for the currency. However, raising interest rates isn't a perfect solution. Higher interest rates also make it more expensive for families to buy homes, for businesses to expand, and for consumers to borrow money. As spending and investment slow down, economic growth can weaken and unemployment may begin to rise. That's why central banks constantly balance inflation, economic growth, and financial stability when deciding whether to raise or lower interest rates. By now, you've probably noticed that exchange rates don't move randomly. They're constantly responding to what happens inside an economy. If you're enjoying this documentary, consider subscribing to Financial Cycles. We create in-depth documentaries that make economics and finance easy to understand. Now, let's look at another major force that can shape the value of a currency: foreign investment. Another major factor that influences a currency's value is foreign investment. Whenever a company decides to build factories, open offices, or expand into another country, it first needs that country's currency to pay for land, buildings, equipment, salaries, and everyday expenses. That immediately creates demand for the local currency. This is exactly what happened when China opened its economy to foreign investment in the late 1970s. As international companies moved into the country, they needed Chinese yuan to operate their businesses, increasing demand for the currency. But attracting foreign investment isn't just about offering cheap labor or low taxes. Investors also want stability. A stable government gives businesses confidence that the rules won't suddenly change. If taxes, regulations, or trade policies constantly shift, companies face greater uncertainty and may choose to invest somewhere else instead. Economic stability matters just as much. High inflation, excessive debt, or repeated financial crises make investors worry. As confidence falls, investment slows, reducing demand for the country's currency. This is why countries compete to attract foreign investment. More investment usually means more demand for the local currency, helping support its value over time. Foreign investment is important. But it's only one side of international trade. The goods a country sells and the goods it buys can also have a major impact. Exports, imports, and trade. Trade is another major reason why currencies have different values. Every time a country exports goods or services, foreign buyers usually need that country's currency to complete the purchase. That creates demand for the currency. For example, when Japan exports cars, foreign companies and consumers need Japanese yen to pay for them. More demand for Japanese products can also mean more demand for the yen, The opposite happens with imports. If Japan imports coal from Australia, Japanese companies need Australian dollars to pay exporters. This increases demand for the Australian dollar instead. For this reason, many countries try to export more than they import. A strong export sector increases global demand for the country's currency and supports its value over time. One of the best-known examples is the US dollar. For decades, most international oil has been traded in US dollars. This became known as the petrodollar system. Because every country needs energy, governments and businesses around the world also need US dollars to buy oil. That constant global demand helped strengthen the dollar's position as the world's leading reserve currency. Of course, global trade continues to evolve, and today some countries are exploring the use of other currencies in international trade. But the US dollar remains the dominant global currency. Not every country has that advantage. Smaller economies with limited exports often have much lower international demand for their currencies. In some cases, they choose to rely on stronger foreign currencies instead, making trade and international business much easier. Trade plays a huge role in determining a currency's value, but some countries take a completely different approach. Instead of letting their currency move freely, they choose to keep its value fixed. Fixed exchange rates. Not every country allows its currency to rise and fall freely. Some governments choose to keep their currency fixed to a more stable one. This is known as a fixed exchange rate, or a currency peg. The government promises to maintain a fixed value. One example is Brunei. The Brunei dollar has been pegged to the Singapore dollar for decades. Another example is Belize. The Belize dollar is fixed at 2 Belize dollars for every 1 US dollar. Because the exchange rate stays the same, businesses, tourists, and investors always know exactly what their money is worth. A fixed exchange rate offers one major advantage: stability. Stable exchange rates make trade easier, reduce uncertainty, and help businesses plan for the future without worrying about swings. But that stability comes with a trade-off. When a country's currency is tied to another, it gives up much of its flexibility. If the stronger currency rises or falls, the pegged currency usually follows. That also means the country's central bank has less freedom to manage its own economy during difficult times. For some countries, the benefits outweigh the costs. For others, a freely floating currency offers more flexibility. Which system works better depends entirely on the country's economy and its long-term goals. But this raises an even bigger question. If stable exchange rates are so useful, why doesn't the entire world simply use the same currency? One world currency? At first, using a single global currency sounds like the perfect solution. There would be no exchange rates, no conversion fees, and no need to worry about one currency rising while another falls. In fact, Europe already offers a real-world example. Countries in the Eurozone share the same currency, the euro. This makes trade easier and allows millions of people to travel, work, and do business across different countries without exchanging money. But sharing a currency also comes with a major challenge. Each country gives up control of its own monetary policy to the European Central Bank. That means individual countries can no longer adjust interest rates or manage their own currency to respond to their own economic problems. The European debt crisis showed why this can be difficult. When Greece faced a severe financial crisis in 2009, the effects spread across the Eurozone. Because these countries shared the same currency, solving the crisis became far more complicated. Now imagine that happening on a global scale. If every country in the world used the same currency, a major economic crisis in one country could quickly affect everyone else. That's why a single global currency remains highly unlikely. And there's one final question. Should every country try to make its currency as strong as possible? No, not necessarily. Different economies have different priorities. A country that imports large amounts of goods may benefit from a stronger currency because imports become cheaper. Meanwhile, a country that depends heavily on exports may prefer a weaker currency, making its products more competitive in global markets. This is one reason why some governments are sometimes accused of deliberately weakening their currencies to support exports. In the end, a currency isn't valuable simply because of the number printed on it. Its value reflects the strength of an economy, the decisions of its policymakers, and the confidence millions of people place in it. And that's why different currencies have different values. If you enjoyed this documentary, don't forget to like the video and subscribe to Financial Cycles. We publish in-depth documentaries that make economics and finance easy to understand. Thank you for watching, and we'll see you in the next one.